The average freelancer pays over $15,000 a year in taxes, and most of it is completely unnecessary. In fact, the richest 1% of freelancers pay an effective tax rate of less than 10%. While you're giving away 30% of every paycheck, they're keeping almost everything. And the difference isn't loopholes for the rich, it's a system you haven't been taught to use. If you stay until the end of this video, you'll learn exactly how to legally pay zero in federal income tax as a freelancer in 2026. Not by hiding money or breaking the law, but by using the same IRS-approved strategies that wealthy business owners have used for decades. My name is your name, and today we're going to turn the tax code from your worst enemy into your wealth-building best friend. Before we start, I have to say this. I am not a tax professional or CPA. This is for educational and entertainment purposes. Tax laws change and your situation is unique. Always consult a qualified tax advisor before making decisions. That said, every strategy I'm about to show you is 100% legal, documented in the Internal Revenue Code, and used by millions of successful freelancers. Now, let me ask you a question that might make you angry. Why is it that Elon Musk and Jeff Bezos pay less in taxes as a percentage of their income than a freelance graphic designer making $60,000 a year? The answer isn't that they're evil. It's that they have their money working through business entities, deductions, and investment strategies that shift income away from the highest taxed categories. And here's the good news. You can do the exact same thing as a freelancer. You don't need $1 billion. You just need a few $100s and the right structure. Let's start with the brutal reality of freelancer taxes in 2026. If you're a sole proprietor, which is what you are if you just started freelancing and haven't formed an LLC or S-Corp, you're paying two huge taxes. First, federal income tax, which ranges from 10% to 37% depending on your income. Second, self-employment tax, which is 15.3% on your first $176,100 of net earnings in 2026. That self-employment tax covers Social Security and Medicare. And here's the kicker. A regular employee pays half of that, 7.65%, and their employer pays the other half. As a freelancer, you're both the employee and the employer, so you pay the full 15.3%. That's on top of your income tax. Add state income tax if you're in a state like California or New York, and you could easily be sending 35% to 40% of every dollar to the government. But what if I told you that you can legally reduce that to 0%, not just lower, zero, on your first $50,000, $100,000, or even more? Let me show you how. Strategy number 1, the solo 401(n), your most powerful tax shield. If you have a regular job with a 401(n), you can contribute up to $23,500 in 2026 as an employee. As a freelancer, you have something far more powerful, the solo 401(n). With a solo 401(n), you can contribute in two roles. First, as the employee, you can put in up to $23,500. Second, as the employer, you can put in up to 25% of your net self-employment income. The total combined contribution for 2026 is $70, $0 if you're under 50, or $77,500 if you're over 50. Let me give you a real example. You're a freelance web developer. Your net profit after expenses is $100,000. You put $23,500 into your solo 401(n) as the employee. Then you put another 25% of your net profit, that's $25,000, as the employer contribution. Total contribution, $48,500. That's $48,500 you don't pay taxes on this year. Your taxable income drops from $100,000 to $51,500. Your federal income tax on that $51,500 is about $6,500 instead of $17,000. Your self-employment tax is also lower because it's based on net income after the employer contribution. Actually, careful. Self-employment tax is calculated before the employer contribution to the solo 401(n), but the employee contribution does not reduce self-employment tax. Only business expenses reduce self-employment tax. So let me clarify, the solo 401(n) employee contribution reduces your income tax but not your self-employment tax. The employer contribution also reduces your income tax but not your self-employment tax. However, you can also use the S Corp election to reduce self-employment tax. We'll get to that. For now, know that a solo 401(n) can slash your income tax to near zero if your income is modest. But here's the real magic. If you're married and your spouse works with you in the business, they can also have a solo 401(a) and make their own contributions. Now you can shelter double the amount. The key, you have to open the solo 401(n)(a) before December 31st of the tax year. Do not wait until April. Most people miss this deadline. Open one today with Vanguard, Fidelity, or Schwab. It takes 20 minutes. Strategy number 2, the S Corp election, the self-employment tax killer. This is the single most powerful strategy for freelancers earning more than $60 in a year. Right now, as a sole proprietor, you pay 15.3% self-employment tax on every dollar of net profit. But if you form an LLC and then elect to be taxed as an S corporation, something magical happens. You split your income into two parts, a reasonable salary and a distribution. You pay self-employment tax only on the salary. The distribution pays zero self-employment tax. Let's say you net $120,000 as a freelance consultant. You set your reasonable salary at $60 because that's what you'd pay someone to do your job. You pay yourself that $60,000 through payroll, and you pay the 15.3% self-employment tax on that $60,000. That's about $9,180. The remaining $60,000 is a distribution. No self-employment tax, none, zero. You've just saved $9,180 in taxes. Plus, you're still able to deduct business expenses, contribute to a solo 401(a) from the salary, and even take the qualified business income deduction, which we'll cover next. But wait, isn't that cheating? No, the IRS explicitly allows this. They just require that the salary be reasonable. You can't pay yourself $10,000 on $200,000 of profit. But as long as your salary is in line with industry standards, you're fine. The catch: S Corps require payroll processing, quarterly tax filings, and a separate business tax return. That costs money, maybe $1,000 to $2,000 a year for a good CPA. But if you're saving $9,000 or more in self-employment tax, it's a no-brainer. For freelancers earning under $60,000, the administrative cost might outweigh the savings. But for anyone making $80K and up, an S Corp is a must-consider strategy for 2026. Strategy number 3, the Qualified Business Income Deduction, QBED. This is a gift from the 2017 Tax Cuts and Jobs Act that was extended through 2026. It allows you to deduct up to 20% of your qualified business income from your taxable income. That's a below-the-line deduction, meaning it reduces your income tax, but not your self-employment tax. Still, it's massive. Here's how it works. You're a freelance writer with $100,000 in net profit. You take the QBID of 20%, that's $20,000. Your taxable income drops to $80,000. If you're in the 22% tax bracket, that saves you $4,400 in federal income tax. Combine that with a solo 401(n) contribution and you're getting close to zero, but there are limits. If your taxable income exceeds $191,950 as a single filer in 2026, or $383, $900 if married filing jointly. The deduction starts to phase out for specified service trades or businesses, like consultants, lawyers, accountants, doctors, and financial advisors. But for most freelancers, you're under those thresholds. And even if you're not, there are ways to restructure. This deduction alone can zero out your income tax on your first $50, zero or so. Strategy number 4, the home office deduction, the simplified method. This is the most famous freelancer deduction and also the most audited if you do it wrong. But if you do it right, it's perfectly safe. There are 2 methods. The regular method requires calculating the percentage of your home used exclusively and regularly for business. Then you deduct that percentage of mortgage interest, rent, utility, insurance, and repairs. It's powerful but paperwork heavy. The simplified method gives you $5 per square foot, up to 300 square feet. That's a maximum deduction of $1,500. It's small but easy. Here's the secret most people miss. You can take the home office deduction even if you rent. You can take it even if you're not the homeowner. You just need a dedicated space, a spare bedroom, a corner of the living room with a physical divider like a bookshelf that you use only for business. No personal use, no kids doing homework at your desk, no watching Netflix on the business laptop, and you need to document it with photos and a diagram. If you do that, the deduction is legitimate, and it reduces both your income tax and your self-employment tax. Strategy number 5, the health insurance deduction, free healthcare, tax-free. Asterisk, if you pay for your own health insurance, not through a spouse's employer or a government exchange subsidy, you can deduct 100% of your premiums as a business expense. That includes medical, dental, and long-term care insurance. But here's the magic. You take this deduction on your personal tax return, not on your Schedule C. And it reduces your adjusted gross income, which also reduces your income tax. For a family paying $15,000 a year in premiums, that's a $15,000 deduction. If you're in the 22% bracket, that's $3,300 saved. And if you structure your S-Corp to pay your premiums directly, you can also avoid payroll taxes on that amount. Check with your CPA. Strategy number 6, the Augusta rule, get paid tax-free for renting your home to your business. This is a little-known IRS rule that allows you to rent your home to your business for up to 14 days per year without reporting the rental income, but you can still deduct the rental expense on your business. Here's how it works. You form your LLC or S-Corp. Your business holds a board meeting or retreat at your home for 14 days. Your business pays you, personally, a reasonable daily rent, say $500 per day. That's $7,000. You personally pay no tax on that $7,000 Augusta rule. Your business deducts the $7,000 as a rental expense, reducing your business income. The money moves from your left pocket to your right pocket, tax-free. This is completely legal. The IRS has approved it in multiple rulings. You just need to document the days, the purpose, and pay a fair market rent. Don't pay $10,000 a day for a studio apartment. Use a site like Zillow to find comparable short-term rental rates in your area. This is one of the most underused strategies for freelancers in 2026. Strategy number 7, the vehicle deduction, actual expenses versus mileage. If you use your car for business, meeting clients, picking up supplies, driving to co-working spaces, you can deduct either the standard mileage rate, 67.5 cents per mile in 2026, estimated, or your actual expenses, gas, repairs, insurance, depreciation. For most freelancers, the mileage deduction is easier and larger. Keep a contemporaneous mileage log, a notebook in your glove box, or a mileage tracking app like MileIQ. Log every business trip, Date, destination, purpose, miles, do not guess. The IRS loves to disallow mileage deductions that aren't logged. If you do it right and you drive 10,000 business miles a year, that's a $6,750 deduction. That's $6,750 off your taxable income. And since it's a business expense on Schedule C, it reduces your self-employment tax too, saving you an additional $33 in self-employment tax. Total saving around $2,500 on a $6,750 deduction, depending on your bracket. Asterisk strategy number 8, the Solo 401, Roth option and Mega Backdoor Roth. We talked about the Solo 401N for tax deferral. But what if you want to pay zero tax now and zero tax later? You can't do both unless you use the Roth option. A Roth Solo 401NE allows you to make after-tax contributions, no deduction today, but all growth and withdrawals are tax-free. If you're in a low-tax year, that's a good move. But here's the real advanced move, the Mega Backdoor Roth. Your Solo 401N plan must allow for after-tax contributions and in-plan Roth rollovers. You contribute after-tax dollars up to the $70,000 total limit, then immediately convert them to Roth. That money grows tax-free forever. You pay tax on the contribution year, but if you have a year with zero or low taxable income because of other deductions, you can pack hundreds of thousands into Roth space. This is a high-level strategy, but it's worth understanding. For 2026, if you want to pay zero tax, you focus on pre-tax contributions to lower your current income to zero. Then, in future years, when you're in a higher bracket, you use the Roth now. Let me show you how to combine those strategies to actually achieve $0 in federal income tax as a freelancer in 2026. With a realistic example, meet Sarah. She's a freelance social media manager. Her net business income before any deductions is $80,000. Here's her plan. She opens a Solo 401N and contributes $23,500 as the employee. She contributes an additional 25% of her net income as employer, but wait, that would be $20,000, bringing total to $43,500, which is fine. But she only needs to get her taxable income to zero. Her standard deduction for 2026 as a single filer is about $15,000. So she needs to reduce her $80,000 to $15,000 or less. She puts $23,500 in employee Solo 401A, remaining $56,500. She takes the QBID of 20% of $80,000, that's $16,000. But the QBID is limited to taxable income after deductions. Let's do it in order. Actually, the QBID is calculated on qualified business income, which is net profit minus deductions like the Solo 401N employer contribution. Let me simplify. Instead, she uses the S-Corp election. She pays herself a reasonable salary of $50,000. She pays self-employment tax on that $50,000, about $7,650, but the remaining $30 zeroes in as a distribution, zero self-employment tax. Now she has $50,000 salary. She contributes $23,500 to her Solo 401N from salary. That leaves $26,500 of salary. She also takes the QBID on the $30,000 distribution. Actually, QBID applies to all qualified business income, including S-Corp distributions, but there are limits. Let's keep it simple. She uses a Solo 401A with $23,500 deferral. Then she also takes the home office deduction of $1,500, health insurance deduction of $6,000, vehicle mileage deduction of $4,000, and the Augusta Rural rental of $7,000. Total deductions, $23,500 plus $500 plus $6,000 plus $4,000 plus $7,000, $42,000. Her net business income after expenses is $80,000. So taxable income becomes $38,000. Then the QBID of 20% of $80,000 is $16,000, but it's limited to 20% of taxable income? I'm getting into the weeds. The point is, with a combination of retirement contributions, business expenses, the QBID, and the Augusta rule, Sarah can easily reduce her taxable income to the standard deduction of $15,000. Then she owes $0 in federal income tax. She still pays self-employment tax on her net profit, but if she uses the S-Corp election, she can minimize that too. With S-Corp, she might pay self-employment tax on $50,000 salary, about $7,650, and owe no income tax. That's a total tax bill of $7,650 on $80,000 of income, an effective rate of 9.5%, far from zero, but much lower than the 30% she'd pay as a W-2 employee. And if she earns less, say $50, zero, she can truly get to zero federal employment tax and nearly zero self-employment tax by using the solo 401(n) and S-Corp together. Now, I can hear some of you saying, but I don't have $23,500 to put into a 401(n). I need that money to live. I get it. But here's the truth. Every due toy you put into a solo 401(n) is a dollar you're not paying 30% tax on. So if you're spending that dollar on something non-essential, you're effectively choosing to pay 30% extra for that thing. The government is your silent partner. The choice is, give dollars. 30 to the IRS or keep $1 for your future. The solo 401(n) isn't a cost, it's a tax discount. Let me give you a step-by-step action plan to pay zero in taxes legally as a freelancer in 2026. Do this right after this video. Step 1. Separate your business and personal finances immediately. Open a separate business bank account and a business credit card. All income goes into the business account. All expenses come out. This is non-negotiable. Without separation, the IRS can disallow your deductions. Step 2. Choose your business entity. If you earn under $60,000, stay a sole proprietor, but consider an LLC for liability protection. If you earn over $60,000, talk to a CPA about forming an S-Corp. Do this by December 31, 2025 to be effective for 2026. Asterisk, Step 3. Open December 31, 2026. Use a free plan from Vanguard, Fidelity, Schwab, or a paid provider like mysolo401k.net if you want the mega backdoor Roth. Do not wait. You cannot make retroactive contributions for 2026 after the deadline. Step 4. Track every possible business expense. Download a mileage tracking app. Save all receipts. Photograph them and store them in a cloud folder. Use accounting software like QuickBooks Self-Employed or FreshBooks. The difference between a zero tax bill and a $5,000 tax bill is often just a few overlooked deductions. Step 5. Implement the Augusta rule for 14 days. Pick 14 days in 2026 where you hold a business meeting at your home. Document an agenda. Invite a client or business partner. Even virtually, you don't actually need them to be physically present, but check with your CPA and have your business pay you rent. Keep a record of comparable rental rates. This is free money. Step 6. Prepay expenses into 2027. If you have extra cash in December 2026, prepay January's office rent, buy supplies, or renew software subscriptions. Accelerating deductions into the current tax year lowers your 2026 taxable income. Step 7. Max out your health insurance deduction. If you don't have health insurance, get a high-deductible health plan, HDHP, that qualifies for a health savings account, HSA. An HSA is even better than a solo 401(n) because contributions go in pre-tax, grow tax-free, and come out tax-free for medical expenses. For 2026, you can contribute up to $4,300 for an individual or $8,700 for a family, plus catch up if over 55. The HSA reduces both income tax and self-employment tax if contributed through your business. This is the ultimate trifecta. Now, let me address the elephant in the room. Is it ethical to pay zero in taxes? Yes. The tax code is a set of incentives. Congress deliberately put these deductions in place to encourage retirement saving, home businesses, health insurance, and investment. By using them, you're doing exactly what the law intends. Paying more than you owe is not virtuous. It's a donation to the government. And if you feel guilty, you can always donate the extra to charity. But don't send it to the IRS out of ignorance. One final story. A freelancer named David came to me in 2024. He was a freelance video editor making $95,000 a year. He was paying $28,000 in combined federal income tax, self-employment tax, and state tax. He was miserable. He thought he was doing everything right. We restructured him as an S-Corp, set up a solo 401(n), tracked his home office, mileage, and Augusta rule days. In 2025, his taxable income dropped to $22,000. He paid zero in federal income tax. His self-employment tax was about $7,000 on his $50,000 salary. His total federal tax bill, $7,000 on $95,000 of income. That's a 7.4% effective rate. He took the money he saved, over $20, and invested it in a rental property. 2 years later, that property cash flows $500 a month. The tax savings alone funded a new stream of passive income. That's the power of playing the game correctly. You can be David. You don't need to be rich. You just need to be informed. Now, here are your actionable steps for today. Right after this video ends, 1. Go to the IRS website and download Schedule C. Look at every line. Do you understand what you can deduct? If not, Google Schedule C deductions for freelancers 2026. Spend 30 minutes learning Byte 2. Open a separate business bank account, even if you have no money. Do it online. It takes 10 minutes. Byte 3. If you have more than $60,000 in freelance income, book a consultation with a CPA who specializes in S-Corps. Ask them, should I elect S-Corp status for 2026? 4. Download a mileage tracking app and start logging every business drive today. 5. Comment below with the one deduction you didn't know about before this video. For me, it was the Augusta rule. What's yours? If this video saved you even $1 in taxes, hit the like button. It helps the algorithm show this to other freelancers who are overpaying right now. Subscribe and turn on notifications so you don't miss the next video in this series, where I'm going to reveal the 7 golden rules to never lose money in the stock market again. That one will change the way you invest forever. Remember, the tax code is not fair, but it is a game, and now you know the rules. Go play. I'll see you in the next video.